Well, it was a huge week of event risk in the financial markets last week, but all those events panned out largely as expected. The Fed raising rates by 25 basis points and indicating that a pause to the hiking cycle is now in place. The ECB also raising rates by 25 basis points, but in contrast to those over in Washington, D.C., indicating that more tightening is to come as we move into the spring and the summer. We also had another blowout non-farm payrolls number out of the US on Friday, with the stunning resilience of the labour market continuing as headline non-farm payrolls beat expectations for the 13th month in a row. It's another busy week for markets this week. The latest US inflation number, by far and away the marquee event risk in the 5 or 6 days ahead, as markets continue to hunt for signs of progress on disinflation. And we also have a decision due from here in the UK. The Bank of England expected to hike by 25 basis points as the old lady continues to grapple with the stagflation that grips the UK economy. It's another busy show on the trade-off this week. Let's get into the show. Well, as I said, plenty going on in the markets, plenty for Ryan Littlestone and I to discuss. So without further ado, let's bring Ryan into the show from Forex Flow Live and Forex Analytics. Ryan, how are you this morning? Enjoyed the long weekend?
Yeah, very much so. Good morning, Michael. Do you have a good weekend too?
Yes, very well, thank you. And I've got to say, we're in the presence of a celebrity this week. He's been papped into his local paper, haven't you?
Yes, our street party that we had over the weekend on Sunday, made it into the local rag. So you got my ugly mug playing Where's Wally amongst the crowd.
Well, before Ryan has to go and deal with the queue of autograph hunters at his door, let's get into Topical Thunder and kick off the show. So I want to start with the Fed this week, pretty much as expected. The FOMC hiking rates by 25 basis points last Wednesday, and really sticking to the script that we'd all expected: a rate increase as markets have fully priced in, and a bit of a tweak to the guidance, ditching the outright hiking bias and stating, and I quote here, that further tightening will hinge on future economic development. So the Fed now firmly in a data-dependent stance, and this is where things get interesting, because you've got a market that is pricing in somewhere between 70 and 80 basis points worth of cuts between now and the end of this year. And of course, the Fed saying, actually, according to their dot plot at least, we are on hold. And if you listen to what Powell was saying at the press conference, he certainly indicated that there was, the base case at least, was that there was no chance of a rate cut coming anytime soon. So you've still got this interesting battle playing out between the Fed and the market. And of course, the famous phrase goes, don't fight the Fed. Well, the market is quite happy to fight the Fed at the moment. It's going to be interesting to see how this one resolves itself. And there's three things that we need to look at. Jay Powell gave us this very, very clearly at the press conference. He said that the framework depends on, one, further progress on inflation coming back down towards the Fed's 2% target. Secondly, the degree to which the labour market softens. And thirdly, how much credit conditions tighten as a result of the regional banking problems and issues which just won't go away in the US economy at the moment. And I think what's important to remember is that the Fed won't be looking at these metrics on their own. They will be looking at these compared to their economic forecasts and what the staff at the Federal Reserve have projected. Now, it's important to remember that the Fed staff expect a recession in the second half of this year. So you've got to view these metrics in the context of what the Fed have been telling us in their forecasts and what the staff have been saying in the minutes. So certainly my base case, and I'm interested to see your views on this, Ryan, as well, is that we stay here. We stay between 5 and 5.25% for the remainder of the year, unless we get a significant deviation to that forecast. And I think as a result of that, the mispricing, in my view at least, that we see in the markets provides quite a good trading opportunity, whether you want to trade rates, whether you want to trade equities, where there's obviously downside risks if the Fed come out more hawkish, or even the dollar, where you would say risks are to the upside if that 70 or 80 basis points worth of hikes gets priced out.
Yeah, well, he played a good game of walking both sides of the line. Every time he said something mildly hawkish, he countered that with something less hawkish or a bit dovish. So it really was a straight sitting on the fence meeting, if you like. And yeah, it has got the market thinking, what's next? I think perhaps they've got one or two more hikes in the pipe. to get up into that ceiling area where they've been looking at getting as the dots have shown. We could be near a pause. This data dependency, it's a pause without actually saying it's a pause. But the market knows actually the most or the least the market knows is that the Fed is very close to the end of this current hike cycle, unless inflation starts picking up again. But the problem we have at the moment, as we've had for years now, is there's so many different plates spinning. One of the big drivers is obviously the US debt stuff going on. And if that gets resolved either by a short-term can kick or a longer-term can kick, say a year or 2 years, then we'll probably see risk rallying on that because that's been weighing on markets a lot. And I think that will give the driver for the dollar higher. But the Fed potentially going on pause, I can't see how that's good for the dollar in terms of rate expectations, because the market is trying to price these cuts. And if they're trying to price that heavily, that means a pressure on yields. It means a pressure on the dollar because that's going to be the bigger move than staying higher for longer for a prolonged period. But we're going to face that battle all through the rest of the year, the pivoters versus the Fed hawks.
Yeah, absolutely. I think that is the key sort of battle or contest that is going to pan out for the remainder of this year. It's, do the Fed do what the market expects, or do the Fed do what they've indicated they're likely to do in terms of maintaining rates at their present level? I was really hoping we would get through the show without a mention of the US debt ceiling. I think everyone is bored of it. Everyone knows it will get resolved. It's a political pantomime, I can use that word because we've got to keep this relatively family friendly. But yeah, I mean, it's already interminably tedious, and that saga is going to run on for a few weeks yet, isn't it?
Yeah, definitely. Yeah, I've been quite surprised at the level of worry about this one because, we had someone pointed out a couple of weeks ago, I think it was Jamie McGeever at Reuters, saying that out of the last 70 years, they've kicked the can 78 times. Yeah. So I don't see how this time can be different. Obviously, as traders, we've got to recognise there is still a risk, no matter how small. But the can will be kicked. It's an election year next year. No one wants to go into that having stopped the federal government from working because of this debt stuff. So it's the same every single time. There's talks, and then we get right to the 11th hour, the 59th minute, 59th second, and maybe they'll get a deal done, or maybe they'll overstep by a couple of days. And then, as I say, we'll probably get a decent relief rally.
Yeah, do you know, I think there's probably two things in terms of the debt ceiling, and we'll move on to inflation in a second. I think the first is that from a risk management point of view, particularly at a more institutional level, you don't want to be the one getting caught out that one time that things are different. That's going to be a very, very awkward conversation with your boss if you haven't hedged for a US default or the debt ceiling not getting resolved, and all of a sudden it isn't resolved, and you're the one going, oh, sorry, I didn't expect this to happen. That's you're not going to have your job for very long after that. No. And the second thing, oh, sorry, Ryan, go on.
I was going to say that where you can see that in today's markets, if you look at the really short-term paper, you look at 1 month, 3 month US bills, and 1 months are running into the 5.5, near 6%. So it's showing that investors are saying, right, we don't want that 1 month risk, which takes us, pretty much into the 1st of June, which is when the debt ceiling or the debt hits, and then they can't pay their bills or defaulters or whatever it's called. So no one wants to hold that paper. So they're coming out of the short end and moving it into the long end or elsewhere until this gets resolved. So that's where you want to be looking, and it's jumbling up markets a bit because it's overshadowing what's going on with rates, with the Fed and everything else.
Yeah, absolutely. I mean, the yield curve's just an absolute mess at the moment. And the other thing is, in terms of a longer-term resolution of the debt ceiling, obviously the Republicans hold the House. What concessions do they eke out of the Democrats in the Senate and obviously in the White House to get a debt ceiling deal over the line? And to what degree does that tighten fiscal policy into that election year, as you mentioned? I think that's probably the bigger question for me. But anyway, speaking of the macro, what about the US inflation data, by far and away this week's key release?
Yeah, here we are again. We can't rest on our laurels too much. We've had the Fed last week, and now we get the next piece of the puzzle with the CPI data coming up this Wednesday. Expectations are for headline CPI to remain unchanged at 5%. The core is expected to dip just 1 pip to 5.5% from 5.6% prior. Now, traders need to know it's the core number that's important these days. The central banks like to do their little accounting smoke and mirrors, where on one hand they talk about inflation in the headline, and then when it becomes sticky, they start to talk about the core number, and that's the one they're concerned about now. And you've heard most central banks talking about stickiness in the core numbers. Now, for the US, we've had the PMIs recently, and they've largely shown across all the sectors that prices remain very sticky, and there are persistent inflationary pressures within those. They may be coming down a touch on some, but they're not falling as much as would be hoped. So we need to keep an eye that whether this CPI is going to be higher or lower, and then between the two. So the headline number, yeah, it's going to be important, but keep an eye on that core. If that headline drops to something like 4%, but the core goes up to 5.7%, the market's going to go with that core number. But moving a bit further than that, just the day after, we've got US PPI. And these numbers are going to be important now, because perhaps we're getting to the point where we're going to start to see negative year-on-year numbers, which we haven't obviously seen for quite some time. That then puts us into this disinflationary stage that the market's looking for at the moment. We've already seen it in some countries. Spain, for example, last week, they showed a negative year-on-year number. All the others really coming down to single figures in a lot of cases. So, we need to keep an eye on that. If we start getting PPI straight after the CPI going into a negative year-on-year, that's going to bring in some disinflationary moves, if you like, in the market. The pivoters are going to go, the Fed aren't going much higher. We're going to be pricing cuts even harder. So that's what we need to look at, two pieces of data, really. But the other thing is we're also seeing a bit of divergence in the data, the inflation data, between some countries. And that's obviously going to have a very important impact on currency crosses, between, say, the Eurozone and the US, so for euro dollar. Because if inflation keeps coming down the US, we've seen it stickier in the Eurozone, that's going to tilt the balance. People are going to be trading Fed cuts, and the ECB may be staying hawkish a bit longer. Then you've got your policy divergence trade in euro dollar there, which I know you're going to talk about it a bit later in the show. So, I mean, what do you think about this inflation picture? Are we at the end, do you think, or is this just a little dead cat dip, if you like?
Have you just invented a new phrase?
Yes.
I was going to say you're in danger of stealing my thunder when it comes to euro dollar. So we'll save that for a bit later on. Is it the end in terms of inflation? Kinda. I'm gonna hedge my bets a bit there, because, as you say, it's the core number we need to watch. It's the core number we need to watch. Headline inflation will come lower. Energy prices have come down quite significantly. Food prices have come down quite significantly. And of course, you've got the base effects coming through from 2022 as well, which will also help to put a bit of downward pressure on the headline metric, whether it be the US, the Eurozone, the UK, particularly the UK, actually, because of the way energy prices here work and the new price cap from April onwards. I think what's important is, as you say, the core number. That's where you can really measure underlying inflation, and that is sticky. There's no getting away from it. Core CPI in the US has been, I think someone, I'm sure in the comments will correct me if I'm wrong, above 5% every month since December of 2021. And there's really no sign that the Fed's tightening, and I know there's obviously lagged impacts of that tightening, there's no sign of it making much of a dent in that core inflation print just yet. And of course, when you look at the labour market report that came out of the States on last Friday, a stellar US jobs market report. Payrolls up by 253,000, unemployment down to an equal cycle low at 3.4%. And more worryingly, that earnings pressure is starting to increase again. Average hourly earnings rose by 0.5% on a monthly basis. And I think all the time, as you rightly said, we see that core CPI number remain elevated. It's going to make it very, very difficult for central banks to even think about talking about loosening policy. Yes, PPI is coming lower. Yes, headline CPI is coming lower. But actually, if you look at some of the underlying metrics and those PMI surveys that you mentioned, I don't think inflation as a story and as a narrative is going away anytime soon.
Yeah, no, I make you 100% right there, and that's going to be the issue. What happens if inflation doesn't come down to target? Does that mean that we're going to go on another bit of a hike cycle, and how high are rates going to go then? 6-7%? Then we start to find a bit of pressure, because that will really start to dent the economy. But all for the future. Let's get through this week first.
Well, I was going to say curveball for you. Do you change the inflation mandate?
Well, they've had a go, haven't they? I mean, what happened to AIT from the Fed?
That was quickly killed off.
Yeah, exactly. That's all disappeared. They haven't mentioned that they've killed it, but they don't talk about it anymore. Oh, yes, we're going to go with average inflation targeting. And, we'll ignore that because we got that wrong as well.
Exactly that. Speaking of ignoring inflation targets, the Bank of England, we hear from them on Thursday. Joy of joys. We have another Bank of England decision coming up. What are we expecting? A 25 basis point hike from the old lady, pretty much locked in. The market prices that with, I think, about an 85% chance, but it would be a huge surprise if the BOE didn't raise rates by another 0.25%. Obviously, that would take bank rate to 4.5%, the 12th hike in a row. But again, the MPC likely to be split. It's very, very difficult to see either DINGRA or Tenreiro voting for a 25 basis point hike, although we must thank goodness that Tenreiro will be leaving the Monetary Policy Committee at the end of June and hopefully taking that idiotic thinking that rates should be cut with inflation above 10% for 7 months in a row. Hopefully she will take that with her back into academia somewhere. In any case, the market doesn't think that the BOE will be done after the rate move this week. As I said, pricing a 25 basis point hike this week, but also pricing another 25 basis point hike in for the June meeting as well. And I think that is perhaps more important, the guidance that the old lady gives us in terms of that June meeting. I think they're going to stick with their tightening bias, but it is a little bit laughable at this point that the BOE are saying we will tighten policy more if we see signs of inflation becoming entrenched and becoming persistently elevated. I don't really know what they want to see for inflation to be persistently elevated, given the figures that we're getting, although I still think 5% is a bit punchy in terms of where bank rate may get to. The more interesting thing about all of this, though, is I think the MPC are going to upgrade their growth forecast. At the minute, they've penciled in a recession. As per their February forecast, they've penciled in a recession for the UK economy in 2023. I think that will probably be scrapped. And a point you were mentioning last week, Ryan, we're not going to get growth that'll blow the doors off. It's not going to be stellar, but some growth is better than none, right? And I think sterling is in an interesting position at the moment. You look at cable, we've finally made our way north of 125, north of 126 as well. And I just wonder whether actually, although the BOE are hiking into a kind of stagflationary environment, whether the BOE this week is going to be another bullish catalyst for the pound, which is enjoying a pretty decent run at the minute.
Yeah, I mean, I'm a bit lost with the pound at the moment, particularly cable. It's a bit like me and my street party about 8 o'clock in the evening, just wandering around aimlessly, not knowing which way I want to go. I really am lost for cable. Other pairs I've got a bit more of a hand on, like euro sterling. But yeah, for the BOE, I still think they're going to be forced to go to 5%. I'm sticking with that. I see no reason, no change in the data to suggest that they shouldn't be doing that on the inflation front. But it's a question of what they decide to do. Could we get a 25 and then indications of a pause? Or are they going to suggest that they're going to keep continuing high and maybe give an indication of where they're going to take rates to a bit more strongly? But let's look at the last two big central banks, even the last three. Look at the BOJ. We've got a big rally in dollar yen, and then it collapsed after. We got a big rally in the dollar into the Fed. Then we got a move down after. We got a rally in the euro up towards that 111 mark over the ECB. Then we ended up lower. So if the market sniffs a pause from the Bank of England, probably we're going to see the same thing, and we're likely to see the pound suffering a little bit. But if they do keep the door open for further hikes and the market gets a little bit hawkish, because it is a monetary report meeting, so we get a presser with this one. Yippee. It could see the pound running higher, but then, as my colleague likes to say, every time Bailey speaks, the pound drops. So you can't rule that out either.
I was going to say, what more could you want on a Thursday lunchtime than Andrew Bailey and his two mates giving us a monetary policy report press conference? It's interesting, actually. One last point on the BOE. I don't think they've paid enough attention to the sterling exchange rate over the last 12 to 18 months. Now, no central bank is ever going to target an FX rate. At least they're not going to tell you that they're targeting one. But of course, you've got to remember, particularly with the way the UK economy is constructed, the weaker sterling is, the more inflation we're importing. And I think that's a risk for the BOE if they do come out a little bit more cautious, a bit more dovish than the market is pricing. 2, 3, 4% decline in the pound, that's only going to worsen your problem when it comes to inflation. So actually, from that point of view and from the point of view of the economy and the state of inflation, particularly core inflation, which is above 6%, it warrants the BOE being hawkish, but then again, when has logic applied to Threadneedle Street over the last couple of years? What about your final topic? Let's dig into the trading psychology a little bit, mate.
Yeah, this is a subject I want to talk about quite deeply, because I find that a lot of traders, they get a bit nervous when in profit. So I want to talk about how you can get over that nerves. And it's really about learning to increase profits and manage winning trades. Because when we trade, we have a stop. It's a definitive moment. A stop is hit, the trade is over. But a lot of traders do that with winners too. Now, I'm going to contradict myself a little bit by saying that, whatever traders do with their profits, if they're banking profits, that's great. I'll never tell anyone don't bank profits, first and foremost. But if you have a profit target, a lot of traders can't see past that. And I'm the sort of trader that doesn't like to give up a winning trade. If I get in a trade, if it's going my way, I want to push that as far as it will go. But there's nothing wrong with taking profit at any time. But we just don't perhaps need to be as rigid with profit targets as we do with stops. And the easiest way to try and run a winner is by taking partial profits along the way. So if you're trading a 20 pip stop with a 30 pip profit target, maybe only take half the trade off if you hit that profit target. Then move your stop up to balance on the rest of the trade, or move it up to entry point, break even on the rest, so that if you do get stopped out, you haven't given much back, or you end up as flat. You can even move it to better, but let the trade go from there. See where it wants to go. Use the levels that stand in your way as places to take more off the trade. We call it the slice and dice strategy in our camp. And there's a great piece of advice that our great coach, Dale Pinkett, uses, a technique. He says, if, for example, let's say you're long, and he would say about profit targets, if you weren't in a position, would you short the asset at the price you would take profit at? And that's a great question, because you say, right, well, I've hit my profit target, I'm getting out. Well, if you weren't in a trade, would you short it there? Would you get in a trade there? And if the answer is no, that tells you that perhaps maybe you're not at the right place to take profit. You could do more with it. If you get to the right place, look at your levels as well. If you're trading off longs off a moving average and 40 pips away on your journey, you've got another moving average. You don't ignore that and say, well, I'll trade one, but I'm going to ignore the other one because I want profit 200 pips away. Use that level to say, right, something might happen here. I'm going to take some of my trade off. I'm going to move my stops up behind it, then see what happens. If it doesn't break, you can always take more off. If it does break, you can bring your stop up, let it run another 20, 30 pips, 40 pips, and then you can take more off. Now, to use another example, I've got probably a 51% win rate. That doesn't sound a lot, but the way I make money is that my winners make more than my losers. So I allow trades to develop, allow the profitable trades to move, and use it by managing the stops behind it. And that way you increase your profits. But yeah, it's something traders, I think, should try. Don't be too stringent with those profit targets. Try it with a couple of trades, taking a third off, a half off, 3/4 off, just seeing what the other quarter does, and see if you can increase those profits.
Absolutely. I could not agree more with everything you've just said. I think that's really, really important advice for traders who might just be starting out, or even people who've been in the game for years and years and years. You are only going to ultimately end up suffocating your account if you are taking winners off the table too early. Obviously, there is a psychological aspect to that. You see a trade move into profit, get to the level that you'd expected it to reach, and you're thinking, oh, I just want to take that off, get the risk to zero. But as you said, you can do that by taking partial profit and adjusting your stop. And I think that's really important advice for all traders out there. So, thank you for sharing your wisdom.
No worries.
Well, with Ryan's wisdom now shared, let's get on some charts. Right, I want to address something that's annoyed me with my first chart. Now, frequent followers.
Something's annoyed you. Don't believe it.
Yeah. Frequent followers of mine will know that it's quite a low bar for something to annoy me. And if I addressed everything, then I'd probably be here until sort of December, something like that. The specific phrase I want to address is the sell in May adage that I'm sure anyone who's been in financial markets for more than about 2 minutes will have heard, particularly around this time of year. And of course, the full phrase is sell in May and come back on St. Leger Day, which for those in the UK will know it's a horse racing event that happens in the early part of September, which is why I've marked that with the green arrow on the chart. The chart shows the seasonal performance, the average performance of the S&P 500 over the last 30 years. Yes, it's a huge time frame. No, you shouldn't trade off seasonals alone, but I've used that huge time frame to try and illustrate why seasonals alone are not something that traders should be factoring into the equation too much. As you can see, if you sold in May, fine, but you're missing out on 2, 3, 4, even 5% worth of gains depending on the year that you're in. And the reason why I bring this up is because the market's relatively range bound. If you look at the S&P 500 at the moment, we're back butting up against this 4,200 mark. We've traded 38 to 4,200 pretty much since the fourth quarter of last year. And every time we get to 4,200, folk come out with reasons to sell. Well, I want to come out with some reasons to buy, because I think the resilience of the market at this point is actually quite staggering. We've had very, very solid earnings. We've had issues in the regional banking sector in the US that the market has shrugged off, and I think that in itself is a bullish sign. We're still at 4,200. The Fed are looking to go on pause, and although the market is obviously pricing rate cuts, I think some accommodation in terms of language, particularly from the more dovish FOMC members, may help things along. And I think the other thing is you've got to remember the economy's doing all right. Expectations are very, very low, but the economy is surpassing those expectations for now, particularly if you look at some of the economic surprise indices that are published. So personally, I still favour buying dips in equities, favouring the tech sector. And the point here really is sell in May is not all that it's cracked up to be.
No, I don't believe in seasonals at all. You know, back in the old days, the black and white days maybe, you know, seasonals were very strong. You used to have the summer driving season in the US, which was big for a while. And it just doesn't happen these days in a lot of things. And if it does, you know, it's not something you can trade. You know, a lot of people jump on these seasonal factors. And if you look at the performance of those seasonals over the last 20 years as a whole, you know, who comes in at the first of the month, buys or sells something because of the seasonals for that month, and then goes away and comes back at the last day of that month to take profit? It's untradeable in my opinion. It can give you a bit of a bias, you know, if you know that it's a strong month for oil, then maybe you factor that in with your trading. You know, you stay more on the long side and you go a bit less on the short side if that's the case. But no, I agree with you on seasonals. But as far as the S&P goes, the one thing I had been noticing in the last few weeks, it has been making slightly lower lows. I'm not suggesting the trend's going to break, but when you're in a bit of a range, and we've been sort of 41, 42s for a while, we've just seen some lower lows coming in sub 41, you know, down to near that 40 area. So I'm a little bit nervous that perhaps maybe, you know, the range is perhaps widening a bit, but the downside might be the easiest path for now, unless we break that 4,200, as you said.
Well, there we go. Diverging views. That's what we want. Euro sterling.
Yeah, well, this is one I trade a lot, euro sterling, and we talked about it a lot on here as well. And obviously, it's going to be a big factor over the Bank of England. So this could be a good mover, based on that discussion that we've just had. Is the Bank of England going to signal a pause, or is it going to continue hiking? Right now, we're nestling right down in a decent support area, down at the 87. This has been one of the big range edges, 87.20 down to probably 86.90, that sort of area. And I'm actually knocking a few longs off this level as we speak now, playing some as a short-term trade and maybe folding some into my core position that I've been holding for a while. But we've got to watch this over the Bank of England, or if it breaks before the Bank of England. A break would probably give it some legs down to at least 86.50, maybe open the door for a move down to, the low 86s. And if the Bank of England is really hawkish later this week, then we could get a move all the way down to those 85, 50, 70 lows down in that area down there. On the flip side, if the Bank of England indicate we're one and done and we're going into pause, then this is probably going to go back into 88 not long after. So good two-way trading to be had here. For now, I'm leaning on the support down here, and we'll see where it goes after the Bank of England.
Indeed. Let me give you a bit of information that I don't know whether you've seen or not, but it may change your view on euro sterling. Goldman went short euro sterling yesterday, which kind of makes me think that we don't want to be going that way.
Yeah, I love it when they go the opposite way I'm trading, because if they go the way I'm trading, I'll start to get cold sweats, particularly if it's someone like Citi or Deutsche Bank or something like that. But yeah, you know what I think of bank forecasts at the moment, mate. The paper they're written on, and they change like the weather.
No, exactly that. I do just think, though, in terms of sell-side sentiment towards the pound is suddenly becoming very, very optimistic. If you look at a lot of what the banks are putting out, and also articles in Bloomberg, even the FT. I think the FT are even starting to get a bit more optimistic on the UK economy, which, that's as rare as hen's teeth. But I do think when you combine that with the fact that euro sterling starting to get towards the bottom of the bottom of the range, cable is starting to get out of the top of its range, I do think that just makes me a little bit cautious when thinking about how much more legs sterling may have to run to the upside at the very least.
Yeah, very much so. And, as traders, we manage our risk. So if that level does break, I'm going to be thinking very carefully about my shorts, but I won't give it a lot of room under that 86.90 handle on this short-term part.
No, definitely. Right, another euro chart. I want to look at euro dollar. FX vol remains pretty subdued. Let's be honest. We had a big week of events last week, but we're still pretty range bound across the board. And I think euro dollar epitomizes this quite well. We're stuck between this kind of 110.75, 111 mark to the upside, and this ascending trend line, which comes in around 109.60, 109.70 to the downside, and price shows no real sign of wanting to break out of that range. I do think, though, that euro dollar, personally, at least, I favour upside here. I like, and it pains me to say it, and I feel like I need to go and wash my mouth out with a bar of soap afterwards. I do like long euro at the moment. The common currency does have quite a lot going for it. The ECB remain one of the last hawks in town when it comes to G10 central banks. If you look at what the commentary has been since the ECB decision last Thursday, it's all been around hikes, plural. So that's June and July in terms of rate increases, another 50 basis points at the very least. And of course, core inflation in Europe, as we were alluding to earlier, shows no sign of abating anytime soon. And I think if we can get a closing break of this 110.75 region, then it is an area where I would be looking to get long. And one of the reasons why I like this at the moment is because there are so many levels. We've been around this point so many times, this kind of 110 level. We've been here so many times in the past for euro dollar. It gives us really, really easy levels to the upside and the downside with which we can manage our risk on a trade which does have some very, very clear macro drivers behind it.
Yeah, I mean, but the surprising thing for me is that we didn't break that 111 over the ECB because they weren't dovish at all. We knew that going the 25 was the concession to the doves. If they'd have gone at 50, that would have been probably 50 and a pause. But they've left the door open, as you say. But the price action is always king. And the fact we didn't break that 111, and we know there's good barrier formations there as well in the option side, was a bit surprising for me because we really should have kicked on. So I get your break point. If we do break 111, we're probably going to be at 112, probably not long after. And we have a huge level above there into the high 114s, 115s, big multi-year levels. But if we can't get above that 111, I'm going to be worried that we're going to get a bit of a steeper pullback, maybe down to the low 109s, maybe even worse. But as you say, it's all to play for in this one. Decent levels to trade against. You can trade shorts perhaps off that 10.75, 111 handle while it still lasts, but watch for that break, because the more times we test without breaking, the bigger those stops are going to be building behind it.
Absolutely. This is very much a waiting game, I think, when it comes to the common currency at the moment. What about dollar CAD, Ryan?
Yeah, dollar CAD, and yet another one we've spoken about quite often here. And probably the reason is because it plays nicely with the levels. And here we are again. We've had another test down towards that trend line bottom there, down towards the low 133s. We've seen another bounce from that. So longs are still looking good in this pattern that we've been playing for the last few months or so. That's come as we've rejected another area, 136.50, pretty much bang in the middle of the recent range. That's held. That's been a historical support and resistance area again over the last few months. So we've had another try down the downside. So longs may be good still off that 133 level. But if we get below that, if we break that, then I think we're on for at least 132.60, 70, then down to the low 132s, 30.00, and maybe then we're moving to a new range. But for a technical perspective, when it plays nicely, the loonie, this one can be a dream to trade.
Yeah, absolutely. I mean, I'm no technician, as everyone knows, but even I can appreciate there's a little bit of beauty in that chart, the way dollar CAD has respected those levels, whether it be those Fibonacci levels or even the wedge that you've got in yellow there that's been so well respected over the last 6-7 months now. So I do think, going back to your point that you made on Eurodollar, the more tests that we get of these levels, the stronger they become, the more orders build up at these levels. And as a result, even when they do break, we could see even more of a run lower. As we were mentioning earlier, I'm not particularly bullish on the dollar at the moment. So I would certainly be thinking if we can get a break of that yellow bottom of that wedge, then we would look for 132 in relatively short order, you would expect.
Yeah, and also keep an eye on oil, obviously, because it's a big driver of what happens in the loonie. And the Bank of Canada, and not to go into it too much depth, I've just got a feeling they've been sounding a little bit more hawkish of late regarding possible additional rate hikes to come. So keep an eye on the data there. If we get a sudden turn there in something like inflation, we could have a bit of an RBA situation where they're on pause, but then they suddenly pull a hike out of the bag.
Yeah, and there was some decent jobs data out of Canada as well, actually, on Friday. Obviously, nobody looks at it because you had the non-farm payrolls number dropping at exactly the same time. But the labour market's definitely just as tight in Canada, if not perhaps a little bit tighter than it is in the US. So, I think the market price is something like a 10% chance that the BOC may hike again at their next meeting. I think that's probably nearer to 1 in 3 in my mind. But as you say, watch that inflation data. That will be key. You mentioned the RBA. I want to talk about the RBA in my play of the day. Almost a seamless transition. It's like we know what we're doing with this show now. The Aussie dollar, as Ryan rightly said, the RBA surprising markets last week with a 25 basis point hike, and also giving us a tightening bias once more, indicating that more rate increases are to come in the months ahead. I think it's quite remarkable that the RBA are doing this. They've came into the year with this statement: inflation's a worry, we're going to raise rates for a series of meetings. Then in March they said, oh no, actually not, we're on pause, and now they're back to raising rates once more. All this flip-flopping is making the Bank of England look competent, but I digress. As you would expect, the Australian dollar has rallied quite significantly in reaction to this, and we're at a very, very interesting level now. We're at this long-standing resistance, the top of the range that we've traded since the middle of Q1 at the 68 handle, and of course you've also got the 100-day moving average here as well. So I would be looking to get long on a closing break of the 68 figure. There's some very, very nice levels below that you can use as a stop. I would favour the 200-day moving average, which we closed above last Thursday for the first time in some time. It's not just the RBA that's working in the Aussie dollar's favour. Chinese equities are doing all right. The S&P is doing all right. Copper is doing okay. And the China reopening story is humming along as well. So I'd be looking for the Aussie dollar to continue rallying on a break of the 68 mark. Of course, the risk to this view is if we see risk appetite take a turn for the worse, then the Aussie dollar is likely to do so as well. But I think that post-RBA move has legs to continue. Ryan, what about gold?
Yeah, gold I'm going to talk about. I just want to make a quick note on your Aussie dollar, because that was my play of the day last week, and I was looking for shorts into that 68 area, which you may have had to wait, but we've hit that yesterday, hit the 68, and it's dipped by 25, 30 pips so far. So the old smash and grab was still valid for that one, but I agree with your sentiment there. If we get a break above, then it's flying high, and one of the drivers of that could indeed be gold. And again, I'm going to look for a break trade on this one above this real solid triple top that we've seen in around the 2075 area. Again, as we were talking about other pairs, when you get so many knocks on the door, if it breaks, you could get a decent move through it. So my trade of the day here is looking to buy a break of this 2075. Two ways you could do it. You could either buy on the dips that we get here, which are looking shallow as we go, or look for a break, maybe 2080, 2085. Make sure it's really through that level before you get in. Then see where it goes from there. First stop's likely to be the big figure at 21. Or you can let it break and then see if we get a confirmation test and rehold of the level. So breaking up to, 2090, 21, then a pull back down. If it holds that 2075 level, that gives you your conviction to then get in that trade because the level's held. And then if it does, then it should push on higher. So, two to watch out for there. A bit of interconnection between the gold and the Aussie. One will drive the other. So hopefully mine will drive your trade.
Well, let's be honest, I don't care which drives which, as long as they both end up on the right side. Well, that brings us to the end of another show. Ryan from Forex Play Live and Forex Analytics, thank you very much, as always, for joining me. Thank you also to our producer, Kyriakos, for bringing this together with his sharp new haircut as well, that sadly none of you can see. Thank you also for watching. If you've enjoyed the show, please drop a like on the video, leave a comment, let us know how you're trading the markets, and if there's anything in particular you'd like us to discuss this time next week. And that's when we'll be back. We'll be back again next Tuesday. But thank you very much for watching, and goodbye for now.